Hello, my dear students. How are you doing? So, guys, today was taxation exam for CA Inter. I drove to Kerala because I came here on official work. So, 10-hour journey. Morning I left and I reached here by 4:30. I was waiting for the paper. So, 5:30 I got the paper, and from 5:30 to now it's what 9:30. I was sitting and checking out the paper and also asked my team to type out the question paper and also the answers that I jotted down. And they have sent me this, and here I am discussing. I think nobody in India has given the suggested answer so quickly. So here we go. So as I told you, last couple of months I was slightly inactive because I had many exciting things to work on, and unfortunately I could not give little bit time for YouTube. But here I am, friends. First time in fastest in India, so to speak, I would say, right? Releasing the suggested answers on the day of the examination itself, as if the paper got leaked, but it didn't get leaked. Okay. So, coming to the initial thoughts, the taxation paper, I would just speak for direct taxes. Uh, I'm assuming you did indirect tax as well, but direct taxes definitely was okay, okay. Not so easy, also, not so difficult, also. Definitely not as bad as law, I would say. It was decent paper, average paper, right? So, cool. So, let's discuss quickly, guys. I'll take you through, and if you want the answers, you can go to the description. It will take you to my Telegram channel, and there you will get the entire suggested answers. You can download it, okay? Okay, one by one. First one. Renu resident individual is 48 years. She has two flats A and B already. So both are used for residential purposes. Flat C she had bought, but it's not registered in her name. But she has taken possession of it. Guys, just by taking possession and by paying a token amount, you will not become the owner. If you have paid some advance in bank account, that will only be useful for SDV purposes. But you will never be called as the owner. You will be called as the owner only when you register it in your name, okay, for all intents and purposes. She has one more flat D, which she had let out in the year 21-22, mind you. And he did not pay rent for 3 months, and she sold the flat on 31/3/24. So, guys, for our purpose, from 1st April 24 to 31st March 25, this flat number D is immaterial, right? Yes. And also, they have given one provision on buyback taxation. Okay, let's see. First question. Which of the following statements is correct? So, guys, very simple. As per 23(2), two houses is self-occupied. The third house is deemed to be let out property. So, flat number A is already used for residential use. Flat number B can also be treated as residential only. Flat C is not registered in her name, so actually it is not considered. But even if you consider that, as per ICI, if you consider, that will be deemed let out property. That's all. Flat D is already sold, so it's immaterial to the question. So, of the options, A and C may appear to be correct, but C is wrong because in C it says B will be treated as deemed to be let out. No, B cannot be treated as deemed to be let out because B is actually self-occupied. So, better answer would be option A. So, in my opinion, option A would be the better answer. Any two flats offered choice will be treated as self-occupied, whereas the other flat will be deemed to be let out. So that's just to say because the third house technically is not hers. Okay, so even if you take it's hers, flat number C, option A would be a better answer in my opinion. Okay. Point number two, Shubh pays the arrears of rent to Renu on 20th June 24. Arrears of rent he has paid, even though he has sold it, no? She is no longer the owner, but arrears of rent she has got now. Uh, and for to get the arrears, she has got 5,000 rupees expenses. So, guys, what is the correct option? Is it taxable? Yes. Arrears of rent will be taxable in the year of receipt even though you are not the owner. So what is arrears of rent? 45,000 into 3, 1,35,000. Will you get the expenses of 5,000? No, because there's a standard deduction of 30%. So what is the taxable arrear? 94,500. Option number C would be the correct answer. Third one. Which of the following statement is correct as far as a buyback? So guys, relevant provisions are very simple. Up to 30th September 2024, buyback tax was governed by 115 QA. But from 1st October is an amendment question. Good question. 115 QA has been withdrawn and a new section 222F has been inserted. As per that, the entire sale consideration will be deemed to be dividend. So the buyback here happened sometime in January, right? January 25. So obviously it is entire thing will be deemed dividend. How much? 8,40,000 will be deemed dividend. It will be income from other sources. There is no exemption of 1,25,000 on all those things. That was only for section 112A capital gains, not for deemed dividend. So 8,40,000 will be treated as deemed dividend in the hands of Reno. So option A would be the correct answer. Option C and all don't do it because earlier cost of all that buyback taxation etc was in the hands of the company. Now it's in the hands of the shareholder. Okay. So very good question this was. Case scenario 2, Sudipto, resident individual, 54 years, gifted shares of an Indian company to his friend Shanu. Gift deed states that shares will be transferred back after Shanu's death and is also retail proprietor. He gave 25,000 to his wife for marketing in charge. She had no qualification, but later she pursued her MBA and then joined back. Then she got the qualification. This is basically a question on clubbing. So first one, first MCQ. Section 61 talks about revocable transfer. So if I've transferred something to you with a view of cancelling the transfer later, then it will be clubbed in my hands. But the exception is if I have transferred to you, but it cannot be cancelled until your death, then it will not be clubbed in my name. In this particular case, Sudipto has given it with a promise that he will not take it back until that other person's death, Shanu's death. So will it be taxable in Shanu's hand or will it be taxable in Sudipto's hand? It will be taxable in Shanu's hand. Clubbing will not apply. So option number B, dividend shall be taxable in the hands of Shanu. Clubbing will not apply. On the other hand, as far as Swati is concerned, spouse's remuneration from a concern, etc., in which the individual has substantial interest will be clubbed if the spouse does not have relevant experience. But in this case, she completed her MBA and rejoined, which means she has relevant experience. So, will the exception apply? Yes. So, will salary of Swati be clubbed in the hands of the husband? No, because she now has relevant experience. Question 6 is a standalone question. Which of the following amount, sorry, the not standalone, 7 and 8 is standalone. 6 1, which of the following amount will be under ATD if he opts out of default tax regime? So if you see there, he paid 54,000 medical insurance for senior citizen parents, interestingly, non-residents. So guys, senior citizens, this is a very interesting question. Senior citizens, section 80D, you will get 50,000 only if it is individual resident, not non-resident. So senior citizen, individual resident, you'll get 50,000. Here it is only 25,000 rupees. Answer B. Independent MCQ, Indian resident bought an overseas tour package of 7 lakhs and remitted 12 lakhs to USA under liberalized remittance scheme. Here it's very simple. Since it's an overseas tour program package, as per the amended regulations, TCS is 5% up to 7 lakh, 20% thereafter. So on that, you will get 5%, 35,000 TCS will apply. Remittance under LRS, other than education, it is flat 20% on all amounts exceeding 7 lakh. So here 12 lakhs is there, 12 minus 7, 5 lakhs. So on 5 lakh, 20%, so 1 lakh. So total TCS will be 35,000 plus 1 lakh, 1 lakh 35,000. Option B is the answer. Moving on. AP and Sons HUF is controlled by Amarendra Karta, Indian citizen who stays in country T and regularly visits India. So guys, here is the residential status of a HUF. Residential status of the HUF purely depends on the residential status of the Karta. HUF is resident if the control and management of its affairs is wholly or partly in India. If wholly it is outside India, I should clearly see the status of the Karta. So in this, Amarendra Karta stayed for 190 days in the financial year 24-25. He satisfies the basic condition of 182 days. And in the preceding 5 years, he stayed 70 days. 70 into 5, 350 days. It is very much less than 730 days, which is required. Hence, additional condition is not satisfied. Here, Amarendra is resident but not ordinary resident. Similarly, HUF is also RNOR. Option D is the answer. Next, on deadly question had come with respect to PGBP. So this was age 58 years, Mr. Ram, who had a PGBP, and in that there are certain other things. All these adjustments were given. So I'll explain quickly by seeing the answer because I've jotted down each and every point, whatever is added to be added, etc. So we have to compute both as per new regime, old regime. So let's finish this video quickly because you can go through these answers later. So net profit as per P&L account, they have given guys 52 lakh. What are the items that you have to add back? First one, interest on advance tax. It's not deductible under 37, add back. Contractor payment, they have not deducted TDS at all. So 30% is disallowed under 40A1A. Advertisement in political party brochure, 37 to be, 40,000 to be added. Interest on cooperative bank, which is unpaid even till the due date, hence under 43B it's disallowed. Expenditure of the previous year, 23-24, is paid in cash this year. So that is deemed to be your income under 48.3A. Don't rate 48.3. It is 48.3A. Okay. Please ensure it's deemed income. Then Prime Minister's National Relief Fund was debited. You should add back because it is claimed under ATG separately. Own contribution under ATCCD, again claimed under Chapter 6A, so added back. Total additions 11 lakh. Items credited in P&L account, but it is not business income. That is interest on FD. It is taken under IFOS. Cash gift from father should subtract, and anyway it's exempt under 56.210 gift taxation. So business profit will be 60 lakh 60,000. Industrial power tariff concession is already credited to P&L account, hence there is no separate adjustment. Yes, interest on FD is separate. So ultimately, my gross total income will come up to 62 lakh 10,000. For that, I should give Chapter 6 reduction under the old regime. So it will come up to 57 lakh 60,000. So under the old regime, this will be the taxation. Since the amount is more than 50 lakh, surcharge also will come, mind you, most important. Because if you don't add surcharge, no answer will change. And then ultimately rounding off, this will be the taxes 17 lakh 62 330. But if I use the default regime, very interesting, important thing, additional depreciation will not be allowed, guys. So you have to add back that 1,50,000 and none of the Chapter 6 reductions will come. So whatever I computed till now, add back 1,50,000 plus your other income anyway. If you add here, if you see, it will come up to 18,28,110. So which is a beneficial option, old regime or new regime? New regime, normal regime only is beneficial because you are getting it 17 lakh 62 330 and not the default regime, right? So one more thing here, audit fee. One interesting adjustment of audit fee. What you may do, you may add back 30%. No, the audit fee is of 23-24, which was not debited that time. It has been debited this year. Correct? So audit fee paid on 31-12-24 is before the due date. Correct? So basically what I'm trying to tell is last year, if they debited, they have not paid. So that time they anyway would have disallowed. This year, they have paid before the due date. What is the due date for financial year 24-25? The due date of filing the return is 31st October 25, not 31st October 24. Correct? A very interesting point, audit fee. Audit fee, actually, there is no disallowance. That's a hidden point. Apart from that, other things are fine. Then question number 2, 6 marks. Shweta, citizen of India, partner in firm in Chennai, provides accounting to corporates in foreign country A, where she is not subject to tax. Correct, she's a partner, citizen of India, partner of a firm, but she is providing to corporates in a foreign country. Income from accounting services, all that. So they have given. Assuming she did not visit India only. Second one, she visits India for some days. Third one, she did not visit India during financial year 24-25. What all is it? So first one, relevant provisions are section 6.1, where stay in India 182 days or stay in India for 60 days and 365 days in the preceding 4 years. If you're a citizen of India leaving India for employment, then that 60 days will be replaced by 182 days. Then the difference between ROR and RNOR. ROR, resident in 2 out of 10 previous years and stay of 730 days in the preceding 7 years. RNOR, resident but does not satisfy the above conditions. Then there is a concept of 6.1A called deemed resident. That is what this question talks about. An Indian citizen having total income, that is other than foreign sources, more than 15 lakh, but is not liable to be taxed in any other country, in the other country, which is this question speaks about that only, shall be deemed to be resident in India, but RNOR if the total income, that is other than foreign sources, is more than 15 lakh. Taxability for ROR, global income is taxable. RNOR or NR, only income received in India will be taxable. Or even if it is controlled from India, the business, that will be taxable. So in this remuneration, they have given 16 lakh, income from accounting services 5 lakh, dividend 8 lakh, business from country A, control from Chennai, 7 lakh they have given. Case number 1, she did not visit India only. Physical presence in India is nil. So she is not liable to be taxed in any other country. Hence, deemed resident concept will come because her Indian income is 16 lakh. Her Indian income, see, 16 lakh. Hence, she is a RNOR. Taxability, Indian income is taxable. Foreign income received outside is not taxable. Dividend received outside, not taxable. All businesses controlled from Chennai, taxable. Case number 2, she stays for 200 days in India every year for 12 years. So in this case, 182 days also is there, plus 200 days every year is there. So she's a ROR. Global income taxable, everything is taxable. Third one, no visit to India, but professional income is reduced to 4 lakhs. Physical stay is nil. Indian income is 4 lakh, not liable in other country also. Deemed resident also will not come, guys, because overall income is not, overall Indian income is not more than 15 lakh. Hence, she'll become a non-resident. As far as non-resident is concerned, only these two will be taxable. That's it. Easy question. Aryan resident in auto parts trade turnover 15 crore data. Purchase goods 105 lakh from Diva LLP. Return goods 5 lakh. Refund received in February 25. Paid 77,000 per month to Mr. Kulvi, resident for catering under contract. TDS TCS. Guys, purchase of goods from an LLP. 194Q will come. Purchase of goods. Buyer's turnover should be more than 10 crore. In this case, this guy's turnover is 15 crore. So definitely 994Q will apply. Seller's receipt from buyer should be more than 750 lakhs in the current year. Here definitely it is 105 lakhs. So TDS will be 0.1% of the sum exceeding 50 lakh. The total purchases 105 less the goods returned also 5, overall 100. So 100 minus 50, 50. On that 50, 0.1%, 5,000 rupees. Since PAN is available, higher TDS will not come. Payment to contractor will be under 194C, guys. TDS payment on contractor. Threshold is 30,000 single payment or 1 lakh aggregate during financial year. Otherwise, 1% has to be paid. Here, yes, same thing. 1% of 9,24,000, 9,250, 240. Will TCS come here? No, because Aryan is the buyer here, not the seller. Correct? And in the TCS provision, the seller should have turnover of more than 10 crore. In this case, Diva LLP has a turnover of only 8 crore. This point has to be written, very important. Money resident individual acquired plot in 2002 for 12,025 plus stamp duty 1 lakh. Sold on 10/10/24. Interesting amendment question. Until 23rd July 2024, it was 20% with indexation. After 23rd July, the property is sold. What property? Land or building or both? In this case, land is sold. So it is 20% without indexation. Sorry, 20% with indexation or 12.5% without indexation, whichever is less. That is the pure amendment question. This is. So cost of acquisition 12 lakh 25,000, stamp duty 1 lakh, total cost will be 13 lakh 25. Sale consideration. Sale 80 lakh, SDV 83 lakh 50,000. 10% tolerance limit of sale you do 88 lakh. So the SDV is less than that. So actual sale value 80 lakh only to be taken as full value of consideration. Indexed cost you should give under both regimes. It is either 80 lakh minus 13 lakh 25,000 or 80 lakh minus 48 lakh 9,750. On one it is 12.5%, on other it is 20%, which is better. With tax indexation only it is better. With indexation only is better. Pure amendment question. Prabhu, resident individual, 45 years, HR manager in private company, salary 80,000, other benefits, rent free accommodation, mobile phone, company car, use of video camera. Pure salary question this is. Basic salary they have given 80,000 into 12, it's 9 lakh 60. Taxation of perquisite, rent-free accommodation. He owns a house, purchased for 2 crore. Taxable value will be 10% of the cost of the house. 10% of 2 crore is 20 lakh per annum. Occupied from 1/12/24 to 31/3/25, 4 months. The perquisite will be 20 lakh into 4 by 12. 6,66,667 will be the rent-free accommodation. Mobile facility, 90,000 rupees provided by the company, hence exempt. Mobile allowance of 1,000, 12,000 rupees taxable. Sale of car to employee. Car was purchased on 1/7/22 for 10 lakh, sold on 1/8/24 for 2 lakh 50. So as per rule, WDV of the asset after depreciation minus the amount received will be taxable. And you should do a written down method as per at 20%. Block method for cost. Cost of the car 10 lakh, WDV for 1 year, second year, and for 4 months. Correct. For valuation, you should take the annual depreciation 6 lakh 40. So overall, how much it will be perquisite? 3 lakh 90,000 rupees. Video, laptop, all these things, video camera, laptop, etc. is exempt perquisite. Video camera, on the other hand, asset other than that, so valuation will be 10% for each completed year of service. Here also, if you make the calculation, 40,500. So overall, guys, approximately it comes up to 20 lakh 69,167. Go through this answer and check whether you have done it correctly or not. Surabhi, resident age 35 years, working partner in 2 firms. Income loss details, partner's remuneration, loss from intraday, income from owning or maintaining resources, LTCG on property, all these details they have given. So you should compute. So partner's remuneration is 9 lakh 70. Intraday, yes, 4 lakh. Speculative business loss to be taken separately here. I mean, you can do that here. So what is that? That is not considered business income. So the business income would be what? 9 lakh 70. I mean, that will be subtracted minus 4 lakh, right? So overall, 5 lakh 70,000. Share of loss from firm, that exemption, loss is not to be allowed. Income from house property, interest on loan for repair she has taken. Guys, interest, if you have taken a loan for repair, then only 30,000 is allowed. Income from capital gain, LTCG on property sold after 23rd July, 9 lakh 20,000, taxable under 112 at 12.5%. Less brought forward, long-term capital gain is also given 3 lakh 80,000. So totally net long-term 5 lakh 40,000. Income from other sources they have given, forfeited advance with sale of shop, interest on fixed deposit, maintaining racehorse, and all those things. So ultimately, gross total income will be 23 lakh 60,000. Only 30,000 is adjusted. Loss brought forward treatment adjusted against current LTCG. Unlisted shares you can adjust against the current LTCG. Loss from owning and maintaining racehorse can be set off only against income from such activity. So that they have given. Current year total income is 7 lakh. Hence, they have adjusted this loss of 25,000 and 6 lakh 75,000 is included in the other sources. Loss on betting of 20,000 is neither allowed to be carried forward or set off. That's it. Speculative business loss is adjusted only against speculative gains. None available and hence it is carried forward for 4 years. That's about it. Other things are the same. So if you see here, remuneration is there, that's fine. There is one problem here. This 4 lakh should not come here, guys. It should be 9 lakh 70 only. I will change this and give you because speculative business loss cannot be set off against income, right? It should be set off only against speculative income. That I'll change it, don't worry. Slightly it will change. But yeah, overall, I hope you got the gist of the story. I'll make changes when I'm posting it, don't worry. Who are the people who are not required to pay advanced tax, not income tax, advanced tax? So these are resident individuals who are 60 plus and do not have income from PGBP. They need not pay advanced tax. And others, if any other SSC where advanced tax payable is less than 10,000 in the financial year, they need not pay. Then they had given one question: an income tax return can be revised only once. False. Under 139(5), it can be revised any number of times. One more interesting question was there: updated return cannot be filed if original return is a lost return. No. Updated return can be filed even if the original return is a lost return, but the updated return should not result in more losses. So the updated return is a gain, then you can file. So that is the question. So this is the entire analysis, guys. Please comment on what you felt about the paper. How did you do? And all the best for the remaining exams. Take care. I'll share you the answers right away. Okay. Love you all. Bye. I'm always for you guys. Don't worry. See you all. Tata. Bye bye. Take care.